Well, global emerging markets over the last 10 or so years have enjoyed spectacular economic growth, and that's been accompanied by equally good equity market returns relative to developed markets. As a proportion of the total investable equity market, emerging markets have risen almost sixfold over that period. So they've gone from being about 2% of the global equity market to around 12% in 2011. It now makes sense for investors to look more seriously at this asset class, as it is such a much larger proportion of the universe. Another factor that supports emerging markets is a rise in population, and you've got a growth of the emerging market middle-class consumer that's come to the fore over recent years. So that very much supports the growth going forward. So also we've got emerging markets that are actually increasingly developed. So they're displaying characteristics much more like developed markets. So by that I mean increased liquidity, reduced transaction costs, lower taxes and capital controls. So they're much more attractive proposition for an investor than they were, say, a few years ago. An index tracking product has two main benefits, particularly in emerging markets. The first is diversification. Now, an index tracking fund in global emerging markets has exposure to 22 different countries. Now, very few active funds can actually offer this because they tend to be more country or regionally focused, as fund managers' expertise tends to be concentrated in these areas. So the benefits of diversification here are that you can actually have a lower risk within a total portfolio context. The second important point is to do with costs. So you've got reduced management charges in an index fund relative to an active fund, but you've also got actually reduced transaction costs because active funds tend to turn over their portfolio more than an index fund throughout the year. So this, together with the management charges, actually create a particularly strong headwind for active managers to offset before they can even get positive performance over the index. So as a result of this, an index fund for a long-term investment is a very compelling proposition. At Legal & General, we've got a lot of expertise in index tracking. We've got around £215 billion of assets managed against index funds across equities and bonds, and that's as of 30th of September 2011. So we've been doing this for some time. We've managed money for external clients since 1986, and we've got a strong commitment to indexation within the business. We've got around 2/3 of revenue comes from index assets. So we believe we're in a very strong position to manage index funds. With this size and scale, that creates opportunities. We have thousands of pension funds and retail fund investors, and they are invested in a variety of different strategies and benchmarks and funds, and they may be doing different things at different times, and may be buying or selling in the market. And what we can do is take advantage of this by potentially crossing orders at mid-market prices, which reduces the cost and produces a better return for investors. Well, within the equity funds index team, we've got 8 fund managers, we've got 2 assistant fund managers, and 2 index analysts. And it's very much a collaborative approach. And we also are regionally focused, so each fund manager will look at a region specifically, and they'll transfer that knowledge and will share ideas within the team. So it's very much a team effort. Well, traditionally, emerging markets were seen as much more of a satellite or almost an alternative asset class. But given their increased importance and significance in the world economy, I think now they can be seen by investors as much more of a mainstream asset class and perhaps deserve a greater allocation than they have in the past. So really the final point is not so much why should investors look at emerging markets, but why not, given their importance now in the world economy.